Sustainability, net zero, carbon footprint, scope 1, 2, 3, RECs, SBTi, GHG. Sound familiar? If you've ever sat in a meeting or read a report and thought, what is going on? You're not alone. In this video, we're giving you a toolkit, a simple, clear guide to all the key terms and buzzwords flying around the world of sustainability, climate reporting, and carbon reduction. You won't need a degree, and we won't bore you with the textbook definitions, just straight up explanations so you can follow the conversation and make informed decisions. Hi, this is Devon, and welcome to Carbon College's Sustainability Glossary, where we take all that jargon, break it down, and explain it in plain English. This glossary is divided into 4 main sections: the basic, measurement keywords, action keywords, and reporting standards. Let's get into it. The basics are the fundamentals. They are used in almost every conversation about sustainability and carbon reporting. Let's start with greenhouse gases. These are the gases like carbon dioxide and methane that trap heat in the atmosphere and are the main driver of climate change. It's often written as GHG in the shorthand. Next, we have carbon footprint. This is the total amount of greenhouse gases caused by a person, product, or company's activities. Say if you drive a car, those emissions count towards your carbon footprint, for example. Next, we have emissions factors. This is a number showing how much CO2 is released for every unit of something else, like a litre of fuel. In the UK, these factors are released by the government and are updated every year. So if you use a litre of fuel, you multiply it by the emissions factor to get the amount of CO2 released. The next few are pretty intuitive terms. Upstream are things that happen before you get a product, like raw materials being made or shipped, whereas downstream are things that happen after you deliver a product, like customers using it or throwing it away. The value chain is all the steps needed to make, sell, and use a product, from upstream to downstream, raw materials, processes, and disposal. In sustainability, we like to look at the value chain as all the aspects a company has some control over. Now let's get into our emissions categories. Scope 1 emissions are direct emissions from things your company owns or controls. Say your company has a fleet of vehicles, the fuel burned in transport is directly caused by business activities and therefore is scope 1. Scope 2 emissions are indirect emissions from the electricity and heat that your company buys. So these emissions have already occurred and are in the grid, and your company is purchasing of this electricity, and therefore they're indirect emissions, but your company still has a large amount of control over them. Scope 3 are all other indirect emissions in your value chain. Suppliers, business travel, waste, and customer use, for example. All in all, there are 15 Scope 3 categories, and these often form the vast majority of the emissions for a company. We'll go through these in detail in another Carbon College video. Net zero is a term we've all heard. It essentially means the process of reducing your greenhouse gas emissions as much as possible and offsetting the rest to get to zero overall. A net zero target is the year by which you want to achieve that zero mark, usually 2050 at the latest. Carbon neutrality is another term floating around, making or resulting in no net release of carbon dioxide into the atmosphere, mainly through offsetting. The difference between carbon neutrality and net zero is that net zero focuses on all greenhouse gases, whereas carbon neutrality just looks at carbon dioxide. Another difference is that net zero aims at reducing usage before offsetting, whereas carbon neutrality uses offsetting as a main mechanism. Therefore, net zero is the gold standard. Climate positivity is going beyond net zero by removing more CO2 than you produce. This could be through forestry or planting trees or carbon capture, while your business's emissions are at net zero. Residual emissions are the small amount of emissions left over after you've reduced as much as possible. These are also sometimes referred to as unavoidable emissions or hard to abate emissions. Shipping and aviation, concrete, cement, heavy manufacturing all fall into this category. Decarbonisation, simply put, is cutting down carbon emissions from a process. Carbon intensity is the amount of CO2 emitted for each unit of output, such as kilowatt hour of electricity, per dollar of revenue, or per item produced. It's about efficiency rather than absolute emissions. And finally, TCO2e. You'll see this a lot. It is short for tons of carbon equivalent. Tons of CO2 equivalent. It converts all greenhouse gases like methane and nitrous oxide to CO2 for ease of comparison. Without getting sciencey, all greenhouse gases have different warming potentials on the planet, and CO2e converts them all to a carbon equivalent so you can compare them. Great. Now let's talk about measurement keywords. These are terms used to describe how we measure and calculate our emissions or footprint. Starting with life cycle assessments, or LCAs. These add up the environmental impact of a product from start to finish. It takes into account the full emissions embodied within a given product. The GHG, or Greenhouse Gas Protocol, is the world's most widely used system for measuring and reporting emissions. This standard dictates how we classify and calculate different emissions so that we can compare across companies in an industry and compare over time. The Carbon Disclosure Project, or CDP, is a global system where companies report their environmental data to help investors and customers make decisions. PCAF It's a method for banks and investors to measure their emissions that is linked to their loans and investments. It's primarily used for Scope 3.15, investment and financing emissions. Then we have the activity-based approach. This is estimating emissions using real-world data like miles driven or liters of fuel. The spend-based approach is estimating emissions based on how much money you've spent and applying the relevant emissions factors. Spend-based approaches are easier and faster to implement and is usually a pretty good starting point, especially when detailed activity data is not readily available. But it is less accurate than activity-based data, which is the gold standard. Cradle to gate is a specific area of LCAs, a specific scope that measures a product's environmental impact from raw materials to when it leaves the factory. It essentially covers the initial stages of a product's life, excluding transportation to the consumer, use phase, and end-of-life disposal. Cradle to grave, on the other hand, measures a product's environmental impact from raw materials all the way to disposal. It encompasses the whole process. Double materiality is looking at sustainability from two angles: how the environment affects your business and how your business affects the environment. It's a two-factor risk and opportunities framework that's central to some new reporting standards. An absolute target is a goal to cut total emissions by a set amount, for example 50% by 2030 or net zero by 2050. It usually has a baseline year and you compare to that. Whereas an intensity target is a goal to cut emissions per unit of output, for example per product made or per pound earned. Usually we use absolute emissions and carbon intensity relative to absolute targets and intensity targets. Energy intensity is the amount of energy used per unit of output, like per meter squared of building space or per product. This is in kilowatt hours and not converted to carbon emissions. And now let's talk about action keywords, and starting with offsetting. We used that term a while earlier in the video, and essentially means paying for products like planting trees that reduce or remove carbon dioxide to balance out your own emissions. There's a lot of different offsets out there and prices vary a lot, and therefore it's commonly accepted that best practice should be to reduce emissions as much as possible, and offsetting should just be used to combat the residual or hard to abate emissions, both to reduce costs and to ensure that these emissions are actually being reduced within our control. Carbon insetting is investing in carbon reduction projects within your own supply chain instead of offsetting somewhere else. These projects directly reduce Scope 3 emissions and help engage with supply chains to reduce any emissions there. Renewable energy certificates, or RECs, are certificates proving you've bought renewable electricity. They offset your electricity purchases from the grid, which is your Scope 2 emissions. A power purchase agreement, or PPA, is a long-term deal to buy electricity directly from a producer. This can be renewable or from the grid, and they usually last between 5 and 20 years at a preset price. Circular economy is a way of designing products and systems so that materials are reused and waste is avoided. It's a way to make your outputs go back into inputs for other products. Carbon capture and storage is technology that traps carbon emissions and stores it underground so that it doesn't reach the atmosphere. The emissions have occurred, but they are being captured so that they don't have the warming impact. Energy efficiency is using less energy to get the same job done, like LED bulbs or better insulation. It's one of the key ways to decarbonize within an organization's control. Demand-side management is adjusting when and how energy is used to cut peak demand and emissions. Batteries are quite good at this. They can get electricity from the grid at low peak times and then use that energy during high peak times. Finally, nature-based solutions are just that. It's protecting or restoring ecosystems like forests or wetlands to absorb CO2. I mean, we all know that trees breathe in CO2, so the more we have, the more they can sequester. So nature-based solutions are how to protect that part of the environment. Finally, we have reporting standards, and in this section, we will have a lot of acronyms, starting with SBTi, the Science-Based Targets Initiative. The Science-Based Targets Initiative is a global group helping companies set climate goals that align with science. These are all about making sure businesses are on track with the Paris Agreement and the goal of limiting global warming to 1.5 degrees Celsius. It looks at your Scope 1, 2, and 3 emissions and projects a pathway to net zero. The GRI is a global reporting initiative. It's a global standard for sustainability reporting, covering environmental and social impacts. It's one of the most widely used frameworks for sustainability reporting, and it aims to be standardized in a stakeholder-friendly way. The IFRS sustainability standards are new global rules for sustainability reporting, merging climate and financial information. These were developed by the ISSV, and they aim to bring consistency and comparability to global financial and sustainability reporting. The focus is on what's financially material for investors, starting with general sustainability and climate-related disclosures. Next, we have TCFD, the Task Force on Climate-Related Financial Disclosures. TCFD provides a structured way for companies to disclose climate-related financial risks and opportunities. It looks at governance, strategy, risk management, and the use of metrics and targets used to track progress. Looking at the UK, ESOS, the Energy Savings Opportunity Scheme, is a UK scheme that requires large organisations to carry out energy audits every 4 years. It helps identify areas where businesses can improve energy efficiency to save both carbon emissions and cost. The SECR, the Streamlined Energy and Carbon Reporting, is another UK regulation that requires companies to disclose their energy use and carbon emissions in their annual reports. It's designed to drive accountability and encourage emissions reduction. The CRP, or Carbon Reduction Plan, is required for suppliers bidding for UK government contracts over a certain value. It sets out current emissions, reduction targets, and concrete steps to reach net zero by 2050. It includes Scope 1, 2, and a small subset of Scope 3 emissions. The CSRD is the EU's new directive that significantly expands sustainability reporting requirements. It covers a broad range of ESG topics, requires limited assurance, and it makes reports digitally accessible to support transparency. The SFDR, the Sustainable Finance Disclosure Regulation, is an EU regulation aimed at improving transparency in sustainable investing. It requires financial institutions to share how green their investments really are and prevent greenwashing in their investment decisions. And finally, we have the EU taxonomy. This is a list of activities that the EU says count as environmentally sustainable. The EU taxonomy is essentially a green rulebook. It defines which business activities are considered environmentally sustainable, which helps investors direct funds towards genuine climate solutions. Each of these reports require some level of information on emissions, and some require emissions on social, and some require information on governance and risk management. The reporting framework that you choose largely depends on the context in which your organization operates and the requirements from customers and investors. Phew! There you have it. I hope that helped clear some of the words and jargon used in sustainability. Sustainability language can feel overwhelming at first, especially when every second sentence is an acronym or a buzzword. But once you break it down, it's a lot more manageable. And hey, you don't need to be a carbon accountant to get your head around the basics. If you found this video useful, or you're curious to keep learning about the world of corporate sustainability, subscribe below to join us at Carbon College. Again, this is Devon, and I'll see you next time.